Imagine waking up one morning to discover that your money has been quietly working harder than you do, growing, multiplying, and building a future you didn't even realize was possible. Now imagine the opposite. Learning that you've been investing all wrong for years simply because no one ever explained the basics clearly. Today, we're fixing that. Because understanding where your money goes shouldn't be a mystery reserved only for experts in fancy suits. By the end of this video, you'll know exactly what index funds, mutual funds, hedge funds, and ETFs really mean, and which one might actually be right for you. But before we dive deep, ask yourself this. If your money could talk, would it say you've been taking care of it or ignoring it? Think about that and tell us your answer in the comments. Let's start at the beginning. When most people hear words like funds, their eyes glaze over. It sounds complicated, right? But here's the simple truth. All four, index funds, mutual funds, hedge funds, and ETFs, are just different ways of putting your money together with other people's money so you can invest in lots of things at once. Instead of buying just one stock or one company, these funds let you buy a whole basket of investments in a single move. That means less risk, more balance, and a much easier path for beginners. But each type of fund behaves differently. Some are slow and steady, some are more expensive, some are more flexible, and some are wild, risky bets that only certain people are allowed to play with. So let's break them down in a way anyone can understand. Imagine walking into a massive supermarket. There are thousands of products, stocks, bonds, companies, industries. You could pick individual items yourself, but that takes time, research, and a lot of guessing. Instead, a fund is like buying a pre-packed basket of goods. Someone has already chosen what goes inside, so you don't have to. But who chooses the items inside each basket? That's where the difference starts. Take index funds. These are the simplest baskets. Nobody handpicks what's inside. Instead, the basket copies an existing list, like a playlist. For example, the S&P 500 is a list of 500 big American companies. An index fund just buys all of them. No guessing, no emotional decisions, no trying to beat the market. The idea is simple. Follow the market, don't fight it. And here's the secret. This simple approach often performs better than fancy strategies. Because index funds don't require expensive managers, they usually cost less in fees. Over time, lower fees mean more money stays in your pocket. If you've ever wondered why many long-term investors swear by index funds, that's why. Now here's a question for you. If you had to choose between a simple strategy that works most of the time or a complicated strategy that sometimes wins big but often loses, which would you choose? Drop your answer below. Next, let's look at mutual funds. These are similar to index funds, but with a twist. Instead of copying a list, a real human manager picks what goes inside. They try to outsmart the market, buying certain stocks, selling others, timing decisions, and adjusting constantly. This sounds impressive, but it comes with higher fees. After all, someone is doing all that work. Sometimes they win, sometimes they lose. But you, the investor, always pay the higher fee whether they perform well or not. This is why mutual funds can be a gamble. You're trusting the skill of the manager instead of the structure of the market. Still, some people like that human touch. Some enjoy knowing someone is actively trying to beat the system for them. Which type of person are you? Do you trust steady systems or skilled individuals? Drop your answer in the comments. Now let's turn the temperature up a little. Hedge funds. The name alone sounds mysterious, exclusive, maybe even dangerous. And that's not entirely wrong. Hedge funds are the private clubs of investing. You can't just walk in, you have to be wealthy enough to qualify, and they can use strategies that regular funds aren't allowed to touch. While index funds and mutual funds might invest in simple things like stocks and bonds, hedge funds can borrow huge amounts of money, make risky bets, short companies, or trade exotic assets. Their goal? High returns, big wins. But high rewards always come with high risks. And while some hedge funds have produced legendary performance, Others have collapsed spectacularly. The important thing to understand is that hedge funds are not designed for the average person. They're like Formula One racing, fast, dangerous, and only for professionals with safety teams behind them. Now here's a question for you to think about. If you had access to a hedge fund, would you invest in it, even knowing the risks? Why or why not? Let us know in the comments. Finally, we reach ETFs, exchange-traded funds. Think of ETFs as the cool, flexible cousins of index funds. Many ETFs behave just like index funds, following a simple list. But unlike mutual funds or index funds, ETFs trade on the stock market all day long, just like individual stocks. That means you can buy and sell them anytime the market is open. Their prices move up and down throughout the day. They're flexible, easy to access, and often very low cost. Want to invest in clean energy? There's probably an ETF for that. Want technology companies? There's an ETF for that. Want gold, real estate, airlines, or even companies that produce video games? There's an ETF for almost everything. This flexibility is why many people, especially beginners, prefer ETFs. You get diversification, low cost, and full control. It's the best of both worlds. Now here's a challenge question for you. If you could create your own ETF, what would it focus on? Technology? Sports? AI? Travel? Tell us in the comments. Your idea might inspire others. By now, you're probably starting to see the differences clearly. Index funds are simple, low-cost, and reliable. Mutual funds are human-managed and sometimes unpredictable. Hedge funds are high-risk and exclusive. ETFs are flexible, modern, and often beginner-friendly. But understanding them is only half the journey. The real question is, which one fits your financial personality? Are you patient and long-term focused? Index funds or ETFs might be for you. Do you like the idea of experts making decisions for you? You might look at mutual funds. Do you crave high-risk, high-reward action and have the wealth to handle it? Hedge funds might appeal, but they're not for everyone. And here's another thought-provoking question. If you could only invest in one type of fund for the rest of your life, which would you choose and why? Share your answer in the comments. If you're enjoying this explanation so far, take a moment to like this video, subscribe to the channel, and share it with someone who needs financial clarity. Your support helps us keep creating content like this. Now here's one last idea to think about. The world of investing can feel overwhelming, but remember this. The most important step is simply beginning. You don't need to be rich to start investing. You don't need to know everything. You just need to start small, stay patient, and choose tools that match your goals. Imagine your future self looking back years from now, grateful that you made the decision to understand your money today. Imagine how different your life could be if you started building wealth now instead of later. So here's the final question. What's stopping you from investing today? Fear? Lack of knowledge? Confusion? Tell us in the comments. Your answer could help someone else who feels the same way. And if you found this video valuable, don't forget to like, subscribe, and share for more powerful content on money, investing, and building the future you deserve.